Hello, and welcome to Insure Wealth, where we give you information and try to let you know about choices you have. Choices about how to take care of your loved ones' financial futures. Choices that might help your favorite charities. Choices that could increase your long-term savings in a safe and secure way. And here to help us understand those choices is our expert insurance advisor, Howard Kaye.
Happy to be here, Michelle, and I'm ready to go to work for you.
Okay, Howard. First, there must be a lot of choices people can make about what to do with their hard-earned money and make sure their loved ones are cared for and free of financial worries. So, can you tell us about some of them?
Well, absolutely. First, let me just start by saying I am not a registered investment advisor. I am in the life insurance business. Again, the purpose here is to really educate everybody on different strategies and solutions that have been created. But many of these things, when we talk about investing, are my personal opinions, and I don't want people to take it for more than what it is.
Right.
But you can invest your money in potentially higher yielding stocks and bonds. And that puts you in danger of being hurt by market volatility and risk. So you have to consider that when going into anything. Or you can keep your money pretty much risk-free, safe, by CDs, treasuries, things like that. But then again, there's no meaningful return because interest rates are so low right now. So
right.
I guess you can, like some people did many years ago, stuff money into the mattress, but nobody enjoys doing that because...
And it's lumpy. Okay.
What ends up happening? The money sits there and then is devalued just by inflation.
Right.
But seriously, there are some ways to get meaningful yields and safety too. And there's one in particular, and what I call it is the everything solution.
Okay, now you're saying people can get a good return on their money and still keep that money safe and more, because safety really is the key with some people, but they also want it to grow. So what's your plan? What is this everything solution? And I'm going to challenge you, and I'm going to, for me and also for our viewers, what is this everything solution?
Well, I'm very happy to do just that, because what I want to tell you is something that people should know as they decide their futures. Like so much else, it may not be for everyone, but it is something that everyone should know about.
Okay, Howard, you're on.
Michelle, let's start out by saying something that may be obvious. Your long-term savings are an important part of your net worth, but, and this is a big but, in today's low interest rate environment, it's a lot tougher to make those savings grow.
So I can invest it.
Yes, but investing it carries with it exposure to market volatility. And if you've been awake these past few years, you know how risky and volatile the market can be. Yes, there can be big rewards, but there are big risks. And if one looks for safety in a CD, well, we know that there's not much growth or return at all.
Well, quickly, let me remind our viewers, for more information, 561-417-5883 or InsureWealthTV.com. So if I want to be safe and I want to get good return, if I want an everything solution, is there something to consider?
Absolutely. Michelle, as you know, my business is insurance. And it's something that I've been involved with for just about all of my adult life. And the reason is simple. I enjoy figuring out strategies for long-term savings. Let me tell you what I've come up with. Here it is. What I call the everything solution keeps your money liquid. That means you can withdraw your money at any time you want with no penalty. It may grow with a meaningful rate of return. The potential is there. Many CDs now return as little as 0.5%, 1%, 1.5% a year. You can do the math. It's not much of anything. The everything solution also has tax advantages, so you can maximize the growth of your account, and it's safe as a part of your diversified savings portfolio.
That sounds like a lot.
Yes, it is. But there is more. You also get a tax-free death benefit for your loved ones when, and as we all do, pass away one day. And there are long-term care benefits to help cover the medical costs we often run into as we get older.
Well, when you talk about an everything solution, how does it work? Because I think that's what everyone wants to know, because it sounds great.
Okay. Let me go through this step by step. And as I said before, it may not be for everyone, but it is something that everybody should know about. I will tell you why we named it the everything solution as we were in a restaurant setting one day ordering a bagel and seeing all the different choices, we said, how about the everything bagel?
Right.
And realized that what this has to offer is everything that somebody is looking for within this long-term savings. Let's get right into it. First, you fund the policy using a one-time single deposit. The amounts can be between $100,000 and as much as $1 million. Then the mechanics of the everything solution kick in. Thanks to a special rider that's attached to this insurance policy, your deposit is 100% liquid at all times. In other words, you can withdraw the money at any time for any reason with no penalty. And let me just elaborate a little bit more on that. What that means is, if you want to take out money each year, you can do that. They let you take up to 10% as a free withdrawal. If you want to eliminate the policy, you can do that at any time without any penalties or surrender charges.
Now, is that for sure? Because I know that every time I hear about a CD, it comes with a statement, and the statement says there's a penalty for early withdrawal. I mean, everybody sees those.
Absolutely. It won't happen with this solution, and that's what makes it incredible to me, the fact that there are no penalties for somebody that says, I no longer want to be involved with this particular program.
Okay, give me more information.
Your account grows by an interest rate that the insurance company will credit to your account. And how is that determined? It's based on the S&P 500's indexes, the S&P 500 index's annual growth, which has a cap. And right now that cap is 13.5%. What that means is, if the market should go up 15%, you make 13.5%. If the market is at 8%, you make 8%. If the market does 3%, when I say the market, the S&P 500 index, if it does 3%, you make 3%. The amount is credited to your account from this growth, and it's typically higher than other secure accounts like what we've discussed, low-yielding CDs, as I've mentioned, or even money market funds. And again, why? Because those accounts are making 0.5%, 1%, 1.5%. Very little money.
Well, what happens if the S&P 500 drops and you could potentially lose money?
Well, it's a great question. As we all know, what happens in the market? You ride the ups and you make money, and if it goes down, you ride the losses. But no, that's not one of the things in this solution. In fact, that's the beauty of this approach. If the index falls, your account gets no interest credited, but you do not absorb any market loss. So in other words, if the stock market drops, the S&P 500 drops, your account is 100% protected because the policy has a guaranteed minimum credited rate that protects you during negative market cycles, even after certain fees are assessed for managing and processing the account that's charged.
Well, Howard, do you make this guarantee? Who guarantees this?
Well, it's my major insurance companies, and you have to understand this is what we call an indexed universal life insurance policy. It's major life insurance companies. But now that we've said that, forget the words life insurance.
Right.
What we're talking about here in the everything solution is a long-term savings program that is an alternative to your CDs, your money market accounts, your treasury bills, bonds, and even those that enjoy playing the market. Here's a way where you can still have the fun with potentially high returns, but
no risk.
No risk, because why?
Because you cannot lose.
You cannot lose if the market goes down. You're just flat.
I'm learning something. Okay,
Excellent.
I love this plan. And again, for more information, 561-417-5883 or online at insurewealthtv.com. Now, earlier you mentioned the T word, tax. Let's talk about the taxes on this kind of policy.
Okay. Again, because we're talking about long-term savings, and unlike most savings instruments, the interest that is credited to the cash value of this account is not taxed until the money is withdrawn. Similar to that of an annuity, okay? Or even if someone's in the stock market, they don't pay income tax on the gain until they sell the stock, okay? Well, in this manner, the money will grow on a tax-deferred basis. It is only when you take the money out that you will pay ordinary income taxes on that amount that's over and above your principal that you put in.
Okay, so along with any discussion of savings, as people get older, and we're all getting older, and we're taking care of our parents, they face long-term care expenses. So how do you handle long-term care expenses with this type of policy?
Well, again, the main component here is the savings feature. But with that, you receive a tax-free death benefit. Now, one of the beauties of this tax-free death benefit is that while the money is sitting there growing on a tax-deferred basis, if you pass away with the policy, that money converts to a tax-free death benefit.
Okay.
So it goes from tax deferral to tax-free death benefit. However, for long-term care, if the insured is unable to perform 2 out of the 6 activities of daily living, they are allowed to access a portion of the death benefit as what we call an accelerated death benefit in order to use it for qualifying long-term care expenses while you are alive.
So you can get a death benefit while you're still alive. Okay. So to help us better understand what you call the everything solution, can you give us some examples of how this works?
Sure.
Okay.
Let's first take someone who's interested in growth and income. We'll call him Mr. Smith. Mr. Smith is 55 years old. Happily for him, he's newly retired. He no longer wants to worry about the market ups and downs and the risk that's associated with that. This is what he says to me. But he isn't exactly thrilled with the very low current rates on, like we said, CDs, savings accounts, money markets, and the like. So he's done pretty well in life, and he decides to use his funds into the everything solution policy, and he starts with $500,000. And now, not only does he have a huge upside growth potential, but he also is completely protected from the risk of any declines in the market. Not only that, as the chart you are seeing shows, not only has his money grown handsomely, this chart is based on the history of the S&P 500 over the past 30 years, which was approximately 8.3%. So you will notice that after the charges for the insurance, you see exactly what his net returns are. If he wants, he can withdraw that income to supplement his retirement. So in other words, he put in $500,000. Everything over that amount of money that he has earned, after his expenses, as we said, from the cost of insurance and administrative fees and so on, he can take out. Also, starting in the very first year, he has a tax-free death benefit. It's $1,289,000. What does that mean? God forbid he passes away. He's certainly not planning on it. But look what his beneficiary will receive, $1,289,000. And look at what he has available in liquid funds after 20 years. Again, based on the history of the S&P 500 over the past 30 years, using this figure, it's grown to $1,880,000 and a death benefit for his family of more than $2,764,000.
That sounds like a really happy retirement and a very nice tax-free death benefit for his loved ones.
Well, Michelle, as the great old jazz singer Al Jolson used to say, you ain't heard nothing yet. Now, let's take the case of a 70-year-old person who is interested in liquidity. We're going to call him Mr. Chandler. He's conservative, and he owns an annuity. I know many of you do own annuities. And why? Because it provided you safety. It provided you, many of you bought indexed annuities where it provides you the upside in the markets with no downside risks. However, the caps on the annuities are much lower, typically 4 to 5%, compared to on the insurance product up to 13.5%. Getting back to Mr. Chandler, he is not happy that the annuity is not liquid. Why? Because there's a long surrender period. In his case, it's 10 to 12 years, and there are steep surrender charges. What does that mean? If Mr. Chandler wanted to take out his money, the insurance company is going to penalize him. So he says for new monies, he'd rather consider now the everything solution as opposed to the annuity. And why? Because he sees safety and liquidity. So what does he do? He puts $1 million into this policy. Not only does it grow safely, but he can take the money out whenever he wants with no surrender charges or penalties. Now, let me say one caveat. Because this is based on an annual point-to-point in the S&P 500 index, interest is credited at the end of the year from the time that he put the money in, basically on the 366th day. So if at that time somebody wants to surrender and take all the money out, they are more than welcome to do so. In the first year, he has $1,708,000 of death benefit, which is tax-free. Not bad.
Not bad at all. Now, here in Florida in particular, long-term care is definitely on people's minds. So how does this plan work for them?
Well, for that answer, let's look at another story, Mrs. Cohen. She is 60 years old. She buys the everything solution with a $300,000 payment. After only 5 years, the tax-free death benefit is more than $863,000. And in that year, assuming she cannot perform 2 out of the 6 activities of daily living, she can withdraw 10% of her death benefit if she chooses, or more than $86,000 to cover for those qualifying long-term care expenses if she needs to. And she can provide herself with additional tax-free funds for her care needs in the future. Remember, when we take a portion of the long-term care feature, you're just accelerating the death benefit. That means it is tax-free. You are getting tax-free money. So in this case, Mrs. Cohen has life insurance coverage and long-term care coverage insurance all wrapped up into one plan. Also, immediately upon funding the policy with the $300,000, a tax-free death benefit is created of more than $750,000, again, from day one.
Here's another issue. I mean, we hear and read every day, I know I do, about people who are in poor health, who have difficulty getting health insurance. And it's been really difficult for these people.
Well, here's another example that addresses just that issue. Mrs. Johnson, she's 75 years old. Her health is not good. She has been uninsurable because of her health. But really, what is her situation call for? She is looking for an alternative to her CDs, to her money market accounts, to annuities, to treasuries. She says she doesn't want to play the stock market because she can't put herself in the position of losing money. So she is really looking for the savings component of this program. The death benefit, while it would be nice if she can get it, she's uninsurable.
Right.
So right now, all her concern is whether I can even have this program or not without the death benefit.
Right.
Well, the answer is no. It's a life insurance product, so there has to be a death benefit. So what's the solution? She has a 50-year-old daughter. Now, what does this mean? Because she has a 50-year-old daughter, this is the answer to her problem. She funds this program with $200,000. She is the owner and beneficiary of the policy, but her daughter is the insured. So all the tax-advantaged growth and withdrawal privileges belong to her, and so do the earnings potential. And as you look at the chart, there's a tax-free death benefit created immediately of more than $679,000 on her daughter. So people in poor health with a child in good health can get terrific benefits. The child doesn't have to pay for anything, and the parent benefits. Remember, the parent, in this case, wanted the ability to have good long-term savings. She wanted the ability to have withdrawal privileges. She didn't want to have liquidity issues. Well, she's able to do that, and who did she use? Her daughter. Upon Mrs. Johnson's death, this is the interesting thing, her daughter can take over the policy. Just all she has to do is change the beneficiary to her children, let's say, and she will now, as owner of the policy, enjoy all of the same benefits. And let me just say one other thing, Michelle. Even if you're not sick, I've had situations where people who are 85 years old and you can't buy the insurance, this particular program on their age. They still want the program. Again, what do? I guess you could say we use a surrogate. We buy it on their children.
And we've seen it the other way around, where younger people have used their parents as the insured.
Correct. That's to create wealth for them.
Right.
In this case, it's the parents wanting to have this solution, long-term savings.
Yes.
They want to get good returns. They don't want risk, but they don't qualify for the program because their health isn't good or they're too old. Now they can use their children. And in this example, it does one other thing. Remember I told you the limit was $1 million?
Yes.
Well, let's say you have 3 children. You can put $1 million in for each one of the kids, so now you can be up to $3 million and you don't have to worry about the limits.
The everything solution. For more information, 561-417-5883 or online at insurewealthtv.com. Now, Howard, if you can, count it all down for us.
Absolutely, Michelle. The people that we've worked with and have used this solution are those that are looking for a number of things. Number one, the ability that you may earn attractive returns on your long-term savings. Why? Because presently you can make up to 13.5% based on the S&P 500 index. That's incredible. Number two, you have the ability of diversifying your overall savings strategy. So you may have bonds, you may have CDs, you may have money market accounts, mutual funds, or stock market investments. While that all may be wonderful, everybody wants to be able to have the ability to create meaningful returns without the risk that typically is associated with it. That's what this everything solution does. Number three, you have the ability to pass on substantially larger assets to your heirs on a tax-free basis. Why? Well, some of the examples earlier where you saw someone put $500,000 into the program, they had a death benefit of over $1 million. Well, if that person or when that person passes away, all of those tax-deferred earnings, the growth, since they had never touched it, convert to a tax-free death benefit. That means the money is all paid out tax-free. The only time you'll pay income tax, ordinary income tax, is if you take that money out during your lifetime. Number four, this addresses long-term care needs. So many of you are interested in long-term care, but have chosen not to buy it, whether it's because of the expense or you feel that you just don't need it and you say, I'm going to self-insure myself. Well, this offers that long-term care where you're able to use a portion of the death benefit on a tax-free basis if you are unable to perform 2 out of the 6 activities of daily living. And something we have not talked about, number 5, this solution also allows people to use corporate assets to address key man life insurance needs. Money that's in your business, but you need insurance on a partner, you may use that to buy the policy so that your money is still growing, yet at the same time you have coverage on that business associate that you wanted. The bottom line is, think of the following: potential growth, no downside, risk-free to the extent of the insurance company, which is safety, and most importantly, while you have a tax-free death benefit and you have long-term care benefits that come with this, to me the most important part of the whole thing is the liquidity. 100% liquidity, so if at any time you are unhappy with the program, all you have to do is surrender it without any penalty, any charge associated with it. You can have your money back. And that is truly what the everything solution encompasses.
There's really so much freedom with this plan, and it really is something for everyone in it. And we really appreciate the education and the explanation here today.
Well, thank you, Michelle. As I said, I'm very excited about this because different than when we talk about estate planning, where The ideas are so incredible, and there's so much wealth that can be created for families all throughout our country, and so much that can be created for charity. This hits a different group. What group does this hit? Everybody.
Right.
Why? Because there are some that say, I don't want to leave more to my family. I don't want to leave more to charity. Whatever the government taxes on, that's fine. And those people are entitled to their opinion.
Right.
But here, you have the ability of safety, tremendous returns, tax-free death benefit, and again, most importantly, liquidity. You got it.
Right. Again, Howard, thank you so very much. You've really given us all a lot to think about.
Oh, it's my pleasure and privilege. Thank you.
Now, let me remind you, for more information, 561-417-5883 and online at insurewealthtv.com. We'll see you right here next week, 5:30 Saturday, right after the PBS NewsHour and just before Bogart on Movies. So long.